As a certified financial planner and enrolled agent, which is the highest credential that the IRS issues, I spend a lot of time reviewing the investment and tax strategies that people are being pitched online. Most of them have the same problem. Today, I'm breaking down 4 of them. Let's get into it. Kicking off the video, we have movie investments. You've probably seen this one all over social media. Someone breaking down how you can invest in a movie and write off your investment in year 1, basically letting the IRS fund your position. The tax code they're referencing is real. It's called Section 181, and it can work like that. Here's the pitch. You put $250,000 into an independent film production. Section 181 lets you write off the entire $250,000 in year 1. At a 37% tax bracket, that's $92,500 back on your tax bill. And if the film does well, you get a distribution return on top of that. Sounds pretty sweet, right? Here's what that pitch leaves out. Under IRS passive activity loss rules, that $250,000 write-off is almost certainly a passive loss, which means it can only offset passive income, not your W-2, not business income. So if you don't have passive income sitting somewhere else, that $92,500 in tax savings doesn't actually materialize. The loss just sits there suspended until you generate passive income or you sell the investment. Now, let's assume the deduction does apply. Independent films lose money more than 90% of the time. So the most likely outcome is the movie tanks, and you've spent $250,000 to save $92,500 in taxes. You're down about $158,000 net. So you didn't save money, you lost it a little bit more slowly. And here's something these pitches aren't telling you right now. Section 181 expired on December 31st, 2025. So it's not currently law for new productions. So if someone is pitching you a movie investment today, ask them one question. Did this production start filming before January 1st, 2026? Because if not, that deduction doesn't even exist right now. The deduction was never the strategy, the deduction was bait. Moving on to number 2, oil and gas partnerships. This one feels different from the movie investment pitch. It feels more serious, more institutional. And that's exactly what makes it dangerous. You buy a stake in an oil and gas drilling project. Typically, 60 to 80% of your investment qualifies as intangible drilling costs, things like labor, fuel, and chemicals, which you can write off in year 1. On top of that, you get a depletion allowance as the well produces, an immediate tax write-off, and a long-term benefit. Sounds like a real plan, right? Here's what the pitch almost never tells you. To get that deduction against your W-2 or business income, exactly how it's sold to you, you have to have a working interest. And that's not protected by limited liability. In practice, that often means you're treated more like a general partner, not the insulated limited partner like you thought you were. What does that mean in plain English? You have personal liability. The same structure that unlocks the tax deduction puts your personal assets on the line. You can't have one without the other. That's not a loophole, that's a trap. And if you invest as a limited partner instead, which is how a lot of these deals are actually structured, your liability is capped, which is good. But so are your deductions. Those losses become passive. Same rule as the movie investments, you can only offset other passive income. Strip the deduction out completely. Would you write a check into a speculative drilling project with declining reserves, no exit, and in the aggressive structures, unlimited personal liability? Probably not. The deduction was never the strategy, the deduction was bait. Moving on to number 3 on the list, permanent life insurance. Nearly everyone has been pitched this one. It doesn't matter what your income is. If you have a pulse, someone has probably shown you one of these products. Permanent life insurance comes in 3 main flavors: whole life, universal life, and variable life. And the pitch is roughly the same for all 3. Tax-free growth inside the policy, tax-free death benefit. Borrow against the cash value anytime, and since it's a loan, it's not taxable. Life insurance, an investment, and a tax shelter all in one. A Swiss Army knife for your finances, as many call it. Here's the problem with all 3. They're insurance products wearing investment costumes. The fees can be high and front-loaded toward the agent that sold you the policy. Surrender charges can lock you in for 7 years or more. The illustration agents show you project rosy returns that often have no guarantee of materializing, numbers that look great on paper, built on assumptions, but presented in a way that makes them feel like promises. And the cost of insurance inside the policy can increase each year as you age, which quietly eats into your cash value in ways the illustration never showed you. So what do I recommend instead? Buy term life insurance. It's dramatically cheaper, especially when you're younger and in good health. Then take the money that you're saving on premiums and invest it in a brokerage or retirement account. Buy term and invest the difference. The math almost always wins. And rounding out the list at number 4, the short-term rental loophole. This one lives on TikTok and Instagram. Someone standing in front of a nice Airbnb explaining how they're writing off their rental losses against their W-2 income and paying almost nothing in taxes. Here's the pitch. You buy a short-term rental, something that you list on Airbnb or VRBO with an average guest stay of 7 days or less. You do a cost segregation study, which breaks the property into components and allows you to write off a significant portion in year 1, often 30 to 40%. So on a $400,000 property, that could be a $120,000 tax deduction, offsetting your W-2 income. You own an appreciating asset and get a big tax refund on top. That's the pitch. Here's what it leaves out. To use those losses against your active income, you have to qualify as a real estate professional, which requires 750 plus hours in real estate and more than half your total working hours in real estate, or pass the material participation test. To pass that, you need at least 100 hours managing the property and more than anyone else involved, more than your cleaner, your property manager, every contractor. If you're already working 40 plus hours a week at your day job, can you honestly hit that bar? Most people can't. And if you don't qualify, those losses don't just disappear, they become suspended passive losses sitting in tax limbo until you either generate passive income or you sell the property. Strip the tax benefit out. Would you buy a short-term rental in this market purely as an investment? For most people, the honest answer is no. The tax benefit was never the strategy. The tax benefit was bait. 4 different pitches. You've seen the pattern. Now, here's the test that catches every single one of them. When someone pitches you an investment as a tax strategy, strip the tax benefit out completely out of the math. Look at the underlying investment alone. If you wouldn't buy it without the tax benefit is bait, and the investment is the trap. One simple test. Apply it to every pitch you get moving forward. So what do the strategies I actually recommend look like? Mostly boring, and that's exactly the point. Max your 401k, backdoor Roth IRA if you're over the income limit, mega backdoor Roth if your employer plan supports it. Max your health savings account. It's the only triple tax advantaged account in the tax code. And after all that is filled, a regular brokerage account invested in a low-cost index fund or a direct index portfolio for even more tax efficiency. More on that to come in a future video. Every single one of those passes the test. Strip the tax benefit out. Would you still do it? Yes. You'd own index funds in a brokerage or retirement account anyway. The tax benefit is a bonus, not the main reason. Tax planning isn't about finding the most clever vehicles. It's about taking advantage of the boring before you ever go looking for clever. And anyone who can't explain why the investment makes sense without the significant tax benefit propping it up is probably selling you something. So there you have it. 4 pitches, 1 test, and a short list of strategies that actually build wealth in a tax efficient way. If this video saved you from a costly mistake, share it with someone who needs to see it. And if you want to know which tax saving and wealth building strategies actually apply to your situation, I offer a 90-day sprint. It's a focused engagement with clear deliverables, one cost, all personalized to your unique situation. There's no long-term commitment required. You can check the link in the description, and I'll see you in the next one.